All right, let's just get right into it. Welcome to The Explainer. If you've been keeping even half an eye on the crypto markets lately, you know things have been absolutely wild. I mean, we're talking historical levels of chaos. I've been staring directly at the data, trying to figure out exactly what is driving these massive swings. And honestly, the deeper you look, the crazier the whole thing gets. So let's cut through all that noise together and figure out what's really going on.
$3 billion. Let that sink in for a second. That is the sheer volume of short positions that just got completely, totally wiped off the board recently. It's a staggering number, right? Enough to make even the most seasoned, battle-hardened trader do a double take. And honestly, a number like that tells us something seismic is shifting just beneath the surface.
And right alongside that massive wave of liquidations, boom, an 11% jump. In just 48 hours, Bitcoin basically went vertical, surging straight past the $71,000 mark. When you see rapid-fire price action like that, it literally forces everyone. I'm talking everyone from your average retail investor all the way up to Wall Street institutions to just stop what they're doing and pay close attention.
Which brings us to the ultimate million-dollar mystery for this explainer. Are we looking at the definitive start of a brand new crypto bull run? Or is this just one giant, politically driven head fake? To answer that, we've got to dig into the underlying causes of this massive surge, and more importantly, separate the actual market momentum from all the narrative hype.
Let's kick things off with part one, the perfect crypto storm. You see, when we look closely at the data, it becomes super clear that this price action wasn't just random market noise. We actually have a trifecta at play here. Step 1, political maneuvering. Step 2, macroeconomic easing. And step 3, the short squeeze. Let's break these down one by one because it's pretty wild how these macro, political, and market forces just perfectly aligned.
Okay, so the first piece of the puzzle is the political catalyst. Recently, President Trump hosted a bunch of crypto executives at the White House and publicly urged Congress to pass a piece of legislation called the Clarity Act. Now, the stated goal of this bill is to give the CFTC primary oversight over digital commodities. Essentially, it's aiming to replace the SEC's current regulation by enforcement approach. Regardless of where you stand politically, the market instantly interpreted this White House push as a massive, massive step toward mainstream legitimacy for the whole asset class.
Then we've got the second driver, the macro catalyst. The U.S. Treasury recently announced it was doubling its buybacks of long-term bonds. Why does this matter? Well, it's a crucial data point because that move effectively eases up financial conditions. It weakens the dollar. And historically speaking, when the dollar weakens, capital goes hunting for better returns in riskier assets. Crypto, being super sensitive to liquidity, was just perfectly positioned with a giant catcher's mitt to grab all that flowing capital.
And that brings us right to the explosive third catalyst. Before this whole rally kicked off, Bitcoin had been trapped in this really tight trading range. And you know what happens then? It encouraged a ton of short sellers to heavily bet against a breakout. But when that political and macro news hit, it sparked an absolute monster of a short squeeze. We're talking $2 billion in liquidations, all forced to cover in a single 24-hour window. That panicked forced buying, that was the rocket fuel that propelled the price upwards so violently. Moving on to Section 2, the Clarity Act explained. Now, the political narrative is clearly driving a huge chunk of this market optimism right now, but we really have to look at the stark contrast between the market hype and actual legislative reality. Betting markets, specifically Polymarket, currently give the Clarity Act only about a 20% chance of actually passing the Senate in September. So yeah, the House already passed it, but the data is telling us there's a very high probability this bill just stalls out completely. So why is it stalled out? Well, critics are raising some serious red flags. They warned that the bill is way too industry-friendly, while seriously lacking in consumer protections. Opponents are also arguing it could open the door to regulatory arbitrage. Plus, there are even some ethics concerns clouding a few of the lawmakers backing it. If we're looking at this objectively, which we always try to do, we have to understand exactly why there's such massive resistance waiting for it in the Senate. This brings us to a really crucial concept, the regulatory clarity premium. Right now, crypto assets are enjoying this nice little price boost based purely on the hope, the expectation that this favorable legislation passes. But if September rolls around and the bill fails, that premium could evaporate in a flash. Analysts are out there warning of a potential 20 to 30% downside correction if that political gridlock holds firm. So yeah, this isn't just political theater, it's a tangible risk factor that could directly impact your portfolio. Let's shift gears to Section 3, Bitcoin versus crypto stocks.
Keeping that very real downside risk in mind, we need to look at how different types of investments are reacting to all this. Because how you choose to get your crypto exposure right now, it dramatically changes your risk profile. Take Strategy, the company you probably know as MicroStrategy, as an example here. They hold a staggering 840,000 Bitcoin on their balance sheet. And the fascinating thing here is the multiplier effect. When spot Bitcoin goes up by 10%, Strategy stock typically jumps 15 to 18%. Holding a crypto stock like this acts as an invisible form of leverage. It works wonderfully on the way up, sure, but remember, leverage always cuts both ways. This perfectly illustrates what we like to call the leverage trap. When we compare realized volatility, which, is basically just a fancy Wall Street way of saying how wild the price swings are, spot Bitcoin sits at about 37%. But look at the comparison. Crypto miners and exchanges, companies like Mara Holdings and Coinbase, they sit at a massive 68 to 90% volatility. So, if you want pure play exposure, spot Bitcoin might be the safer bet. If you want amplified returns, those stocks will absolutely give you that, but they will also deliver crushing losses on a downturn. You really have to know what you're buying.
All right, Section 4, the bull case versus the bear case.
So where exactly do we go from here based on the data? Let's map out the two most likely paths. The bull case assumes the Clarity Act actually passes, which would theoretically pull a ton of institutional money right off the sidelines. I mean, we're already seeing spot ETFs pulling in over $1 billion weekly. If that keeps up, major firms have some massive price targets out there. 21 shares sees a recovery to $100,000, and Fundstrat is even pointing to a potential $250,000. But let's pivot to the bear case for a second. If the bill fails in September, it likely triggers a sharp reversal. On a technical level, Bitcoin is still trading below its medium-term 50-day moving average, which is your classic signal that the bears still have near-term control. Actually, Fundstrat themselves are warning of sharp 30% swings in either direction. So no, the bears are absolutely not out of the picture yet.
Which leads us perfectly into Section 5, your investor action plan.
With those two wildly divergent scenarios in play, let's take all this macro and political data and turn it into some concrete steps. Here are 4 ways to help you cut through the noise and manage your risk objectively. Number 1, don't chase the FOMO. The short squeeze is pretty much over. Buying in right now means you're buying the narrative, not the momentum. Number 2, watch the Senate in September. That is going to be your key indicator for that regulatory premium we talked about. Number 3, know your own risk tolerance. If you own highly leveraged crypto stocks, maybe consider balancing them out with spot Bitcoin or ETFs just to manage your exposure. And finally, number 4, have a strict plan. Decide right now, today, at what price you will take profits and exactly where you will cut your losses before the emotions take over. Ultimately, the crypto market is sitting at a really fascinating crossroads right now. We're literally watching massive political tailwinds and macroeconomic easing collide head-on with severe regulatory uncertainty and extreme volatility. Navigating all of this, it's not about blind optimism, and it's not about blind pessimism either. It requires disciplined, informed decision-making based purely on the data. And please, always remember, this explainer is just meant to educate you on the source material. This is definitely not financial advice. Always do your own research. Which brings us to the final thought I want to leave you with today. Are you feeling bullish or bearish on the Clarity Act? Take a moment to just reflect on the political odds, the macro data, and that wild market volatility we just walked through. What's your perspective on where this all goes next? Thank you so much for joining me for this explainer. I really hope it helps clear up some of the chaos for you, and I will catch you on the next one.